Hey, this is Jeremy Goodrich, the owner of Shine Insurance Agency and your host for the Shine Insurance YouTube channel. We are going to dig in this video into the coinsurance clause, one of the most kind of complex and important elements of any property insurance policy, specifically for business owners or investment property owners. I'm going to go through it quickly. I'm going to give some examples. And when you walk away from this video, you're going to understand this important part of your insurance policy better than you ever did before. There's three things we're going to dig into in this video. The first is simply, what is the coinsurance clause? I obviously don't expect you to know it. It's like this weird insurance-y thing. And so I'll explain it. The second is some examples, specifically 4 very quick examples of scenarios where the coinsurance clause could come into play. And finally, what I think you should do to make sure that your insurance policy is set up properly. There's a bonus as well. Our 4th topic will be the hidden effect of the coinsurance clause, specifically on small claims. I'll dig into its effects on even small claims. So let's get into it. What is it? It is a rule that's inside of an insurance policy. And insurance policies have lots of rules, but this is one of them. And the coinsurance clause is the rule put in many policies that penalizes you for underinsuring your property. So anytime you've said to yourself, well, you wanted me to insure my property for $500,000, I think I should only have to insure it for $300,000. The coinsurance clause is in the policy to address those situations, whether we like it or not. This is the insurance company saying, hey, we know people like to underinsure their properties sometimes because it lowers their premiums. And so we're going to penalize them for that act in a claim scenario. And that's often something you don't know is going to happen and makes a claim super uncomfortable. So when does it apply? Well, this clause is generally a part of a commercial property insurance policy. This could be your investment properties. Maybe you have lots of single-family homes, or maybe you have commercial properties. Maybe you have a skyrise in Chicago that's 100 stories tall. Any of those types of investment properties could and probably do have a coinsurance clause connected with them. So the first thing you need to understand the coinsurance clause is replacement cost. And this is simply what it would cost to rebuild your property. I've created other videos about this, so I won't dig deep into it, but we're not looking at market value. We're not looking at what the city or county has assessed your property's value at. We are looking what it would cost us to rebuild your property. So to understand the coinsurance clause, you have to understand replacement cost, and it is the amount it would cost to completely replace your building. So that is the wood, the metal, the floors, the windows, the contractors, all the stuff it takes to rebuild your property. That is what we're looking at as a part of our process. And your insurance agent will make an educated guess, and that will become the dwelling coverage on your policy. So no one knows exactly how much it would cost to rebuild your property unless something bad happens and we actually have to do it. So insurance agents are experts in trying to figure out a replacement cost estimate, our best guess based on your building specifications of what it would cost to replace your building. And that's part of our job, is to create that dwelling coverage and to talk you through why we came to that place. Some policies, if you're looking at your policy right now, refer to this as the coverage A. Usually it's the first coverage described on the property coverage of your policy. And you can look at that right now, and it should reflect probably close to the market value, but again, has nothing to do with the market value of your property. It has everything to do with how much it would cost us to replace your building on your policy. So this coverage is on your policy, and it's only an estimate. I really already described that. So there are 2 types of coinsurance clause that I see the most, and this isn't going to make a ton of sense right now, but after we go through the examples, I think it will make more sense. So it's either 80% of replacement cost, which is actually good, or 100% of replacement cost, which is actually bad. So we'll look at those 2 things, and I think you'll come to understand why you don't want to have a 100% coinsurance clause on your policy. You want to have an 80% coinsurance clause on your policy. All right, let's look at example number 1. So let's say on your policy, and I'm just making up numbers here, but I'm going to try and make them nice and round so they make sense. We decided to cover your property for $200,000. We felt the replacement cost on your property was $200,000, and the coinsurance clause is 100%. So your coinsurance clause, 100%. Dwelling coverage is $200,000. And then, unfortunately, let's say that your house kind of burns to the ground. You have a total loss. This house once was there. Now it's gone. It's a covered loss because it's a fire, and that's covered on your policy. But you have a total loss in this situation. So what's going to happen is an insurance adjuster is going to come out from the company. And these are incredibly powerful people in your claim situations. You should treat them well, talk kindly to them, because they make a bunch of decisions in the scenario. And the first decision they're going to make is what they think it would actually cost to replace the house that burnt down, or the structure that burnt down, or the building, whatever it is. So your dwelling coverage, remember, was $200,000. The coinsurance clause on your insurance policy, remember, was 100%. And the insurance adjuster has now come out after the loss and decided that the actual replacement cost, what they think it will actually cost to replace your structure, is $198,000. So very close to what you were insuring for. So here's how coinsurance comes in. We're going to calculate a couple of things, and I'm going to try and make this kind of as clear and straightforward as possible. It's a bunch of math, but we can do it. We can handle it. It's going to be okay. So it's basically the replacement cost. And remember, the insurance adjuster figured that it would be $198,000 in this situation, times whatever your insurance or your co-insurance clause is. In this case, your co-insurance clause is 100%. So a very simple math problem, $198,000 times 100% is very simply going to be $198,000. Now, I put the word should in there, and that's because this is what the insurance adjuster will have figured that you should have insured for. This simple mathematical formula figures what you should have insured for, and in this case, it's $198,000. So they're saying you should have insured for $198,000. So let's continue with the claim situation. You should have insured, based on the adjuster's assessment using the coinsurance clause, for $198,000. The dwelling coverage was $200,000, right? It was more than you should have insured for. Very close, really, but more. And so the percent payout in this claim is going to be 100% of the loss. You were insured for more than you should have been insured for based on the coinsurance clause. And so the payout will be 100% of the loss. They'll pay out whatever the loss was. And so you will have no penalty. There won't be any coinsurance penalty. And so in this scenario, you would likely have a payout of $198,000. The caveat would be minus your deductible. So if you had a $1,000 deductible, it would be a $197,000 payout. But in this case, the coinsurance clause was not really a factor because you had insured properly for what you should have insured for. So that was example number one. Coinsurance clause really doesn't come into play. Let's look at example number two. Same dwelling coverage. We insured for the same amount, $200,000. The coinsurance clause, again, was 100%. Not the best scenario. We really don't want that to be our coinsurance clause, but let's say it was on our insurance policy. In this case, the house burned down, and the adjuster came out, and the adjuster decided that the replacement cost on the house was going to be $250,000. Now, we can already see that the replacement cost for the house is more than what we were insuring for. And that tends to be a sign that we could be in trouble with the coinsurance clause. So let's take a look at how it plays out. So we're going to again figure the replacement cost, which we had at $250,000 based on what the adjuster says. Our clause is 100%, which makes a very easy math scenario. And what we're going to say is that we should have insured for $250,000. So that's what we should have insured for. So let's look at the claim scenario using that. So we should have insured for $250,000. What we actually insured for was $200,000. So we are going to divide 200 by 250 to get the actual percent payout in the situation. So if you take a calculator, you do $200,000 divided by $250,000, you'll find that we were insured for 80% of what we should have been insured for. Now here's the kicker. Everything else in this scenario is going to pay out at 80%. So you will experience a co-insurance penalty in this situation, right? The payout is only going to be 80% of what it should be. So you'll experience a penalty. Now they're going to use the coverage that you actually had, the $200,000, even though you should have had $250,000, and even though it would actually cost $250,000 to replace your house, they're going to use the $200,000. Then they're going to multiply it times 80%. And your actual payout in this claim situation is going to be $160,000 minus your deductible. Now notice that's $40,000 below what your dwelling coverage was, so that's a bummer. You're already $40,000 out of pocket. But the reality is it's going to cost $250,000 to replace this house. And so you're almost $100,000 under the actual replacement cost. So by the time you replace this house, you're going to be maybe $90,000 out of pocket because of this co-insurance clause. So you definitely got nailed in this situation with the co-insurance clause because we were underinsured on the value of the property that we were trying to insure. So that is the power of the co-insurance clause and how it can affect a claim. Imagine knowing that you have to pay $250,000 to replace a structure and the insurance company is only going to pay out $160,000. Now, if you know that from the start and you're okay with it, I guess it's fine. But if you don't understand it, it can really make you unhappy, make you feel like the insurance company kind of pulled one over on you, and that's the feeling that you get from not understanding the co-insurance clause and ending up getting hit by it in a claim situation. So that's kind of a bummer situation here, example number 2. Let's go to example number 3. And what I like about example number 3 is it shows you exactly what happens when your co-insurance clause is 80% instead of 100%. So watch this. Same scenario, same exact scenario as example number 2. Our dwelling coverage is $200,000. The only difference is that instead of having a 100% coinsurance clause, we had an 80% coinsurance clause, which again, I think is the best option. We had an 80% coinsurance clause instead of 100, and the adjuster came out in that total loss situation and decided again that it should have been insured for $250,000, that it's actually going to cost $250,000 to replace this property. Well, let's see how it plays out in this situation. Remember, all we've changed is the coinsurance clause is now 80% instead of 100%. So we do replacement cost, which the adjuster figured at $250,000, times the coinsurance clause, which now is 80%, and we get to $200,000 is what we should have insured for. So instead of it being $250,000 with the 100% coinsurance clause, now it's lower because we have a more reasonable coinsurance clause, and it's at $200,000. So we should have insured for $200,000 based on the coinsurance clause. Our dwelling coverage was $200,000, and so our payout is going to be 100% of the loss, although that is based on the coverage you had on the policy. So the policy is not going to pay out more than you actually had covered on the policy, but there isn't any penalty because of the coinsurance clause. There is no penalty because of the coinsurance clause. And so in this case, we're going to see a claim payout of $200,000, the entire amount that you had coverage for on the policy. It may still cost you more to fix this house. In this example, it looked like it was going to cost $250,000, so you're still going to have to pay $50,000 out of pocket, but you are getting paid out the full amount of your insurance policy, again, probably minus the deductible, which I haven't really taken into factor here. So that's the power of the coinsurance clause. Just by lowering it from 100% to 80%, we had no penalty, and we were paid out the entire amount that we had coverage on in that situation. So those are 3 examples of how the coinsurance clause can affect the claim scenario in a loss in a loss scenario. So what should you do? Well, there's two very simple things that I think that everyone should do with their policies. You should always insure reasonably close to full replacement cost on your property. In most places, the lowest I would ever insure for is $100 to $125 per square foot. Nicer, more custom properties are going to be much more than that. You really need to have that conversation with your insurance agent, but you want to make sure that you are reasonably close to full replacement cost. Don't cut down, I want to save a little bit of money on my insurance policy. Yes, you can save some money on your premium, but you're going to get nailed in a claim situation, and that is not what anybody wants. So I encourage you to insure at a reasonable cost, close to full replacement cost. And like I've said like 3 times in this video, make sure your policy has an 80% co-insurance clause. Do not get a policy with a 100% co-insurance clause. It is too easy for that clause to burn you in a claim situation. In fact, an 80% co-insurance clause doesn't often cost you much more in your insurance premium. So make sure that you have that 80% co-insurance clause. It's going to make claims a lot better. All right. We're on to the fourth thing, the hidden effect of the co-insurance clause. And this is the part that was hardest for me to understand when I was first learning this. And so I think it makes sense that it would be hard for anyone else to understand as well. If you noticed, the examples that I used in this video were all total losses. The whole place burned down. We're going to have to completely rebuild that place. But it's important to understand that the co-insurance clause applies to partial losses as well. Anytime there is a loss on a policy that has a co-insurance clause, the adjuster is going to come out and figure the full replacement cost of that property and compare it to what you were actually insuring for. Even if the loss is only $10,000 or $5,000, it doesn't matter. They're still going to go through the same process and pay out in the same way using that co-insurance clause. So let's use that example from number 2. Remember, we had a dwelling coverage of $200,000. We had a co-insurance clause in that case of 100%, and the adjuster found that the replacement cost was $250,000. So we were underinsured, and we had a 100% co-insurance clause. So we should have insured for $250,000. The dwelling coverage was $200,000, and the percent payout was 80%. You remember that from example 2, right? But what if the claim was a $10,000 claim? It wasn't a total loss. It was just a small claim. I mean, $10,000 is still a lot of money, but it's a small claim compared to the whole place burning down. Well, the co-insurance clause still applies. So it still has the same effect on the claim. And this can really frustrate folks in a claim scenario because it's just like, wait, what? It's not a total loss. I don't understand, but it does. It still applies, and so it's still going to affect your payout. And since the percent payout in this example is only 80%, the company would only pay out $8,000 on this claim, and again, minus the deductible. So if it was a $10,000 claim in this scenario, it's only going to pay out $8,000. Let's say you have a $2,500 deductible. Now you're down to $5,500. The insurance company is only giving you $5,500. It's going to cost $10,000 to fix the damage that happened. It can make you really frustrated. And I'm not defending the co-insurance clause or anything like that. I'm not taking a position on this. My job is to explain to you how it works and why it's so important to understand it so that in a claim situation you understand. Again, if you had an 80% co-insurance clause in this example, you would get paid out the entire $10,000 because you were insured to the proper value based on the co-insurance clause. So I hope that makes sense. So let's just kind of review what we dug into, these 3 topics. What is the co-insurance clause? It's a way for the insurance companies to make sure that you're actually insuring to at least close to the value of your home. We use some examples. In some of them, the co-insurance clause didn't really matter. In others, it really burned the person in that example. And what to do, 2 things really. I think you should insure to full value, as close to full value as you can, and just to make sure you have an 80% co-insurance clause, no higher than that. And finally, that bonus topic, the hidden effect of co-insurance. It affects small claims too. It's not just full losses. It affects them all. The co-insurance clause plays into all claim scenarios in a policy that it applies to. Okay, that's it. So what is next? As always, the last step in this video is to subscribe to our channel. Look, we try and create some great videos for you. Hopefully this one helped you. You know, this is a specific one, right? Like you were someone who really wanted to understand the co-insurance clause. You know it, you're questioning it. Other videos that we have are more general, really talking about business insurance and other things like that. So make sure that you subscribe to our channel so that we can get those best videos out to you as quickly as possible. All right, well, it was a pleasure chatting with you today, even if it is about the co-insurance clause, one of the nerdiest bits of information in the insurance world. Hopefully you feel a little bit smarter about insurance, and we really enjoyed sharing it with you. If you have questions or comments, or you just think it's total baloney, please go below this video, mention your comments, ask me your questions. I'd love to get back with you there and describe to you more about this piece of the insurance scenario and just make it a little bit easier for you. All right, until the next time, have a wonderful day.